Hi, everyone. Thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by TradeBait, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can now trade these on the DOM on TraderBait's main platform as well. They're a great way to get exposure to the futures markets with limited risk. Go to placeyourtrades.com to go get the TraderBait app for free. I also write a weekly blog and daily pre-market overview that you can subscribe to at placeyourtrades.com. I will be doing a summary of this episode with my key takeaways that will be available to download as a PDF. So if you're interested in getting this PDF, click on the link in my feed. I'll also put it up in the Nest. It's coming up shortly. And the PDF overview will be available and emailed out to anyone that signs up. And just as a reminder, this material is presented solely for informational and entertainment purposes, not to be construed as a recommendation, solicitation, or an offer to buy or sell, long or short, any securities, commodities, or any related financial instruments. Please contact a licensed professional before making any investment or trading decisions. And now time to introduce our guests. We have Randy Woodward. Randy is a managing director at the Fixed Income Capital Markets Division at Raymond James Financial. Randy is a seasoned finance professional with an illustrious career spanning over 3 decades. Starting his journey in 1988, Randy joined Bloomberg Financial Markets, where he showcased his prowess as a programmer before transitioning to sales. His impressive tenure at Bloomberg saw him serving clients from coast to coast, exemplifying his ability to adapt and excel in varied roles. In 1995, he pivoted to a new challenge by becoming a fixed income broker, and for the past 28 years, Randy has specialized in serving primarily depository institutions, underscoring his profound knowledge and commitment to the sector. His vast experience and dedication to excellence make him a stalwart in the world of finance. And next, last but not least, we have Remy Teto. Now, in 2012, Remy made a seamless transition from technology to the complex world of finance, a move sparked by his key role in successfully rebranding Raoul Pal's influential macro newsletter and platform Global Macro Investor. During his tenure at GMI, he progressed from an analyst position to head of research for over 10 years, where he developed a knack for simplifying intricate economic theories and often using charts to create captivating, understandable narratives. His professional path took an exciting turn when he co-founded Real Vision, at the forefront of shaping its identity and bringing it to life, dedicating the initial years to molding the platform's content, branding, and technological infrastructure. Subsequently, he led design and tech teams, a role that allowed him to merge his passions for creativity, technology, and finance. And with that, welcome, gentlemen. How we do this is in a round, so we'll do 2 rounds of questions each, and then the final round, which is the final thoughts round, is the same question for both of you. And with that, we'll go ahead and get started with Randy. So first, I want to start with your thoughts on the landing camp. So which are you in? Are you in the hard landing, soft landing, or no landing camp?
Well, just to make sure everybody knows, that lovely bio Tracy read from me came to you from Chat GPT. So 2 months ago, I had to speak to a client board, and he said, "Hey man, I want to introduce you. I need a bio." I'm like, "Oh God, I don't know what to say. I've been doing bonds for 30 plus years. It's not good enough." He's like, "That's not good enough." So I just put my resume into ChatGPT, and that long bio description is what came out, which I think is kind of funny. I don't know if Remy did it, but I did it. Um, let's see. Uh, you know, as a bond guy, I will tell you, to preface for everybody, to be a good bond salesman, a good bond trader, I kind of look at everything like, okay, how is this going to blow up in my face? And especially because most of my career has been selling bonds to banks and deposit credit unions and whatnot, and they got to get their money back. So, they got it. Return of principal is the number one goal there. So I kind of have a, pessimistic view kind of on everything, the economy, anything in life, pretty much. I look for how can I get, screwed here? And I try to prepare for that. So I personally think we're going to have a very hard landing. And I think it's going to be a lot worse than anybody expects. And they certainly can't tell you that, but I think they're starting to sort of hint to that, you know, I think they're in the process of making a pivot because they know what's coming. That-
And that kind of leads, go up. Sorry, did I?
No, you go.
Well, that kind of leads me to my next question is, Powell's been very steadfast in his, higher for longer as far as rates are concerned. Yet, at this last meeting, he kind of turned to a dovish tone. Is that what you also saw? And if so, why the abrupt change? And what are you, and are they seeing something in the market that we don't?
Well, yeah. First off, they're always going to see things that we don't. I mean, it's so interesting. I watch on Twitter that everybody thinks they're stupid. They don't see this. They don't see. They see all. They're very, very smart people. They have incredible research staffs, and they're going to get information we're just never going to see. But he most certainly, it isn't necessarily my opinion of whether they're pivoting or not. Go look at what the bond market did. Of course, that's what the bond market saw. That's what Fed funds futures saw, and it was clear as day to us. And that's evidenced by the fact that they sent John Williams out Friday morning in a 100, and that was a surprise visit, by the way. That was not on the calendar Wednesday and or Thursday morning, midday Thursday. All of a sudden, we find out Williams is going to be on CNBC the following morning. And I knew exactly what that was going to be. That was damage control. I mean, when you've been doing this for so long, I've seen this act out many, many times. So I knew exactly what he was going to do. And he went on there with Leisman, and it was a 100% scripted. You can't even really call it an interview. It was a 100% statement. Hey, the market's reacting too much. That's not what we said, blah, blah, blah. And it didn't work. And so then you got Goolsby coming out all week. I mean, I think he's at least 4 times. And last night was on Fox, was very, poignant and going, where the Fed cannot be bullied by markets. Well, we're in that phase when you turn from one direction to another, where the markets can bully the Fed. And that's what we're going to find out over the next probably couple months is who's in charge here. Sometimes markets are in charge. I think that's what we're going to see in this cycle.
So do you think that, Fed's pricing in 3 hikes and the market's pricing in 6?
Yep.
So, is the market getting ahead of itself here?
You don't really know. Who knows? I mean, and we can't really do those forward contracts out there in, 6, 8, 9 months or whatever. I don't know how big the volume is, and that can change dramatically. But I think what you want to do is really focus on the near term. I think right now it's more like, okay, when are we going to get started? And, right now the market is pretty much saying for March, it's, futures trading 84%, and that's pretty much 100. So right now the market's saying they're going to start in March. And the Fed has tried to say, no, we're not going to start that soon. But that's the dance right now. And we still got a lot of time, but right now there's the severity is there. The market is expecting, a lot of cuts next year. And the Fed is trying to sell the idea that's going to be like 2 or 3. But the debate is the start date. That's probably a more important date, because if they can delay a cut for a while, then that kind of sells the idea, well, maybe we can get away with 2 or 3. But, that's the battle right now, is when they start.
So do you think this this rally in the bonds is sustainable, or is it like a temporary short squeeze? Because there seems to be two camps on that.
Yeah, I mean, I think it is. I mean, listen, I can tell you that, my clients, all my banks around who haven't had money in a long time are, starting to get some cash flow. They're starting to invest. You see a lot of these, what we call a loss trade, but basically going ahead, we've had about, according to what we see, about 200 banks have gone ahead and taken a loss on their AFS portfolio and reinvested that money. So, the demand there. And I think the trend lower is in, and that's what the inverted curve has always been telling us, is that eventually rates are going to go back lower. And not, it doesn't time it necessarily, but it tells you what the eventuality is. And they've always been right.
Well, then you answered my next question. I was going to say, is that, we've had an inverted yield curve for almost the longest in history. So is it this time it's different, or a recession is coming? So I take it you believe a recession has definitely come.
Well, I do. Yeah. And I mean, yeah, I think you're seeing it in all sorts of different places. And I know the big debate really is, deficit spending. And that's usually the comeback that somebody will get on Twitter, or somebody saying, well, the Fed, the government's going to keep, printing money and deficit spending. I don't know. I guess maybe, but, we got to pay for that eventually too. That's taxes. So I'm not sure that's, going to be sustainable. So yeah, that's where I think we're headed. And, hey, it's probably never going to be as worse as I might think so, but, prepare for it.
And then how do you square that with, I know that, I think we're going into an election year, right? And so I think the goal, well, of course, Yellen's going to try everything she can to avoid a recession, right? Because that would be terrible for the Biden administration. So how does that square, if we have Yellen, issuing bonds, Fed cutting rates, and fiscal spending is definitely not going to stop. So where does that lead us if we're talking about inflation? Does that cause inflation to come roaring back if you have kind of all this stimulus? Or do you see something different happening, more sort of in the Lacey Hunt camp,
Right.
where you see deflation?
I'm 100% with Lacey. And, and it's a complicated world we have. And I know our monetary system has gotten more complicated over the years. But the fact is, we haven't seen M2 drop like it's been dropping since the Depression. I mean, this is a hell of an experiment that we created a ton of money in COVID with stimulus and QE and all the various ways you can create money, and hard money, hard cash money into your checking account. And now we're kind of trying to take it back, and that's why he points to ODL, which is other deposit liabilities, which he believes is the most fungible, spendable currency. And that just keeps coming down. It basically bank deposits. It just keeps coming down, coming down, coming down. There's a lot of reasons for that. But the fact is, that's money that, is meant to be spent, and it's coming down. So I don't know how my opinion, I don't know how you avoid deflation, which is a much scarier monster for the Fed anyway than inflation. And that's why I said this many times, when he's been asked in his pressers, in his efforts to lower prices, he jumps immediately on that person and says, no, that is not what I'm trying to do. What I'm trying to do is bring down the rate of change, disinflation. I'm just trying to lower inflation. I'm not trying to bring prices down, because that's deflation. And he sure as hell doesn't want to deal with that. And a lot of people don't understand that. A lot of people don't understand that fighting inflation isn't about bringing prices down. They're probably not. There's a lot of prices aren't going to go back to what they were in 2019, maybe ever.
I absolutely agree with that. All right, we'll come back to you, Randy. Let's move over to Remy. Remy, you recently wrote a fantastic piece titled Memento Mori, which translate, remember, you must die. And you wrote that the S&P 500 is on its way to make new highs. And this is exactly what you would expect before a recession. So can you kind of walk us through this a bit?
Yeah, sure. So, what I realized, not long ago, or what I remembered really, is everybody was scared of rate cut, and I would have rate hike, and I would impact the market, and it will collapse, blah blah blah. But what happened in history is when the Fed hike, the stock actually goes up every single time. If you separate each segment and compare them in time, that's what you see. And then I realized that personally, I was in a wrong camp this year. I was expecting the Fed to pivot early, and so I didn't see the rally in the stock because of that. And I think that what I remember then is that a recession come after the market make an all-time high, not when the market corrects, or not before that. This is like an historical pattern always happen.
And so, and I can put a couple of those cards up in just a second. And because you highlighted that there's a clear correlation between Fed target rates and S&P 500 performance. And I will again show some examples of that you had in that piece. And of course, you can always go and look that up. But then I kind of wanted to ask you the same question as Randy. Which camp are you in as far as inflation, deflation, or stagflation?
I'm on the same camp than Randy. I think there is too much euphoria in the market, absolutely everywhere. We see it in positioning, we see it in sentiment, we see it in price now. Various indexes making new all-time high. And really, when you think about it, you don't short at the bottom, or you don't become bearish at the bottom. You have to do it at the top if you want to nail it. So I think it's the hard landing is, for me. I mean, I have a whole framework backing it up. Around the U.S. construction, the debt level, find the cost of financings, high rates that are too high. And the problem now for the Fed is going to be more that how long time they're going to keep it above a certain level. Even if they cut, we know that the impact of rate, there's a lag, and usually it takes some time for the market to absorb it. And the high rate, really, we haven't felt the pain yet. And Powell warned us about that this year. He said it. And if you overlay a few charts, versus the Fed rate, like the VIX, for example, or I think the ISM as well, you can see that there is a 2-year lag. And it means that the rate, basically the real impact of the yield, we should see it next year on the market.
Okay, and then what are you seeing? Because you're in Europe. What are you seeing in the markets right now over there, and maybe some differences or similarities to the U.S. markets that we are seeing here?
Yeah, I'm not looking much at at Europe, to be honest. I know we made all-time high the same. Dynamic has been the same. It looks like a recession is going to hit year before. About the inflation, in the end, it's all about the velocity and how it came up. It came very quickly. On the way down, it's going to go down. It went down very quickly. And that's why I think it's going to be very hard to avoid deflation, simply because of the velocity of the move. It's basically, you can't do everything they've done to tackle it and suddenly say, well, we are 2%, it's going to be fine. No, everything is going to keep moving. It's like a a huge oil tanker, right? You can't just switch it and just like very quickly change the course. So I think deflation is on the table, definitely. And yeah, that's it for me.
All right. Let's talk about your thoughts a little bit on hard assets, in particular gold, which has had a phenomenal rally lately, although one could say that it's been in a range for the last 3 years. But do you see us finally breaking that triple top decisively? And, how do you see gold performing during this rate cutting cycle, if that is indeed what is to become?
Yeah, I'm not too much of an expert on gold, although it is the pattern is definitely very interesting. I think next year is going to be, it's set, it is set to break the 1250, 1270 range. And it's going to be back. The thing is, I think we're going to have, most likely a cycle of cutting rates, easing rates. And then after that, we should get, if we are in a recession or if it's needed, that's when we're going to get the easing, the money printing, basically. And when that happens, I guess this is when you're going to want to own gold, or I would say Bitcoin as well.
And then where does that put the dollar? For your thoughts on the dollar? So you're looking at the dollar, basically we hit the high already, or what are your thoughts on the dollar in this scenario?
Well, I think there is a possibility we see actually the gold, and we see them going up, although it's not normal. It's not a normal behavior. We saw it in the past. It happens for a short period of time, and it could happen. I mean, I don't see the dollar weakening either. So I have that weird framework with I do have the dollar going up as well with gold or Bitcoin. Although I know it's not something that you usually see or you would expect. But I think, I do have dollar going up.
Okay, and then back to Randy. I want to get your thoughts on the muni markets right now in light of the fact that Citibank just shut its muni business. So can you kind of give us your thoughts on that right now?
Well, first off, I want to go back, comment a little bit on the hard asset thing.
Again,
having been doing this for so long, one thing I've kind of figured out over the years is when it comes to like oil, gold, Bitcoin, nobody knows what the hell it's going to do. End of story. Everybody's right at the right time and everybody's wrong at the wrong time. And it's just, trying to predict it is so difficult. To me, like, I own a little gold, I own a little Bitcoin to stay interested. That's about it. So trying to predict that to me has been saying, that's kind of what Yellen said to Congress when she was asked about, where's the dollar going to go? She goes, in the end, nobody really knows. There's so many moving parts. So I just want to throw my 2 cents in there. Muni market, that city thing was kind of interesting. I don't really know why they shut that down. Now, I will tell you, that's fairly common. I remember when I was working for Bloomberg and I was on 499 Park, I would walk down to First Boston, which is just down the street, 10 blocks or so. And this happens all the time. I walked in one day and the entire muni department was gone. I mean, just from one Friday to Monday, I was like, well, where'd everybody go? And they're like, we shut it down. So that kind of stuff happens. Now, in this case, the beneficiary was my firm. We ended up, there was a big muni deal that was supposed to get done by Citi, and it went to Raymond James, which was kind of a nice bonus for us. But other than that, the muni market seems, very strong, and a lot of good issuance and a lot of good demand for that world.
Well, there was a bright note.
To the angst of Meredith Whitney. Her name, remember that whole thing she had, the thesis that all the media blow up in the country. And she, by the way, she wasn't wrong. I mean, when her numbers were right. It's sort of like, I'm trying to think of another example, but hey, yeah, your numbers are right. Here's the problem is that you can't let munis fail because that infects the entire system. So they'll always be bailed out. The bad actors will always be bailed out. They simply have to be. Because if you don't, you'll get basically a run on municipalities, so you can't let them fail. So, and that's kind of, one side note, I want to plant this seed. The two people I find most fascinating over the last, since probably the great financial crisis, is I followed Hussman really closely, John Hussman, for years. His fundamental analysis about the stock market, and he's basically been saying, look, it's got to blow up. Here's the fundamentals. And he's not wrong. He's 100% right. And, and it was an error that I made is, I followed his logic and bet against the stock market, which was not a good idea, obviously. I mean, I remember Jeremy Siegel from Wharton going on CNBC when the Dow was like 10 or 11, 12,000. He's like, it's going to go to 25,000. I'm like, that guy's an absolute lunatic. I can't believe he's teaching at, an Ivy League school. And guess what? Not only was he right, he was, way more right than he probably even knew. The problem is that then you got to add somebody like Mike Green. If you don't follow Mike Green from Simplify, you simply have to. And his whole thesis on passive investing and how our money, the money that goes into these ETFs and goes into Vanguard, it gets invested indiscriminately. It doesn't give a shit about the fundamentals at all. It just gets distributed by market cap. End of story. If you haven't heard that thesis, go read that thesis. And that's what I discovered was Mike Green's thesis of passive trumps Hussman's fundamentals. I don't know when the two match up. I don't know when reality hits, but that's my general feeling kind of on anything that can fail right now. It just can almost.
Then, yeah, Mike Green's work is excellent. I agree. But what are your thoughts on the commercial real estate market? You posted a chart of the what was it? The growing number of loans dispersed with a loss.
Yeah. Listen,
can you kind of go over
yeah.
that? Yeah. Can you kind of go over that? And do you foresee this causing a contagion elsewhere?
Yeah. Again, I'll preface it by I'm a doomsdayer. It's kind of just been the way I am my whole career. And to me, it protects me from bad things. But I don't see how CRE can't be an absolute dumpster fire. All the numbers I'm looking at and the way properties are valued, there just isn't another result. And I think what everybody needs to understand is that it isn't like resi. Okay. It doesn't trade the same. When you're looking at commercial real estate, it's about income flow. Okay. End of story. And how much you pay to maintain that income flow. Okay. How much you pay in rates and whatnot. But most importantly is the value of that property is based on how much it costs you to service your debt versus your income flow and whatnot. And what's called a cap rate, about what they expect to have that property yield. Well, cap rates are basically doubling. Okay. So if I'm borrowing, at 3.5%, 3%, a cap rate 4%, you do the math, the property is worth whatever, let's say 2 million. Well, if you double the cap rate, all of a sudden, just on that alone, the property is worth, let's say, $1 million. So all the debt that has to be matured and refinanced, which is normal, you don't, on commercial, you're not just getting a 30-year loan like we do with a house. You've got anywhere from probably 2-3 years to 10 years fixed. And yet that's it. Even though it might be amortized in 30 years, you have to retire the loan and refinance it. Well, here's the problem. This is the big problem is you can't get the money from that property to pay the loan off. So you go in there, you might have $1 million for loan on that $2 million property. The property is now worth $1 million, 70% LTV. You're down to 700,000. And then if you're lucky, it's 70. It's probably more pushing towards 60, 50 at this point. You can only get 500, 600, 700,000. And you got to show up with 1.4, which means you got to, if you don't have that equity, what do you got to do? You got to either turn the keys in or you got to sell the property, take a loss, whatever. And then Jeff Snyder, the Eurodollar guy, he just put a podcast out yesterday. Go listen to it. And it's great. It's only like 17 minutes. This is exactly what he's describing. And to me, that's the bomb getting ready to go off. Now, let me continue real quick because it's important. I hate to ramble, but a couple of months ago, a directive came out, a very, very important directive came out. And whenever they do it in combination, you have to pay attention. So the Fed, FDIC, OCC, what other acronyms, NCUA, they all came out with a combined directive saying, okay, we know there's some stress in CRE. So here's what we suggest. And basically, they gave about a half a dozen examples of how you can extend a loan into the future. And you can't just extend these things indefinitely. Regulators won't let you do that. But they said, like, let's say here's a loan, you extended a year, you did this, you did that. It went from a 70 LTV to a 105 LTV. Normally we would frown upon such efforts, but that's okay right now. Okay. So what they're doing is all of them are saying, hey, we know there's stress. We know, we don't want you to recognize a failure yet. So extend it to next year, delay it. And my belief is they did that because they know damn well they're going to be cutting rates next year because it's the only thing that's going to help us. And it's not going to solve CRE. It's going to alleviate some pressure, but there's no way in hell it's going back down to zero bound with 4% cap rates. Yeah, that's really important. Now, one more thing. Right after Powell's speech, which to me was a complete pivot. I mean, higher for longer just died right there. That's the end of that story. The FDIC came out with an additional called an advisory. And it's the same thing. It was last updated in 2008. And they're doing an update I think they went out Thursday or Friday. And it said, again, we know there's stress in CRE. We're going to be open-minded to how that's handled going forward. And we need you to work hard, to cure these things. Don't let bad things happen but also make sure you are, protecting yourself capital-wise to not have a problem either. So the timing of all these things should not be lost on anybody. I think there's a bit of a panic in the air with all the regulators.
Well, and then what happens to all these banks that are holding these loans? Fed's got to come in and save them again? I mean, is this going to be like a March?
Well, look,
repeat?
Yellen earlier in the year, she basically promoted the idea that, hey, we think bank mergers is going to be a healthy thing. So, I mean, that's basically saying there's going to be some banks that are going to have to get merged into bigger banks because, they've got a loss they can't handle. So, instead of just a flat out failure, we're going to, have a forced marriage with somebody. And that's essentially what they've been doing, and I don't really, this whole Signature Bank portfolio, loan portfolio is really fascinating because, I forget who bought it. Somebody here, you guys might remember, but somebody bought like 20% of it. I think it's probably JP Morgan. I don't know. Or no, it was like BlackRock, I think. But, the FDIC still holds 80% of that. So, I get what they're doing. I get what they're trying to manage. But like, are you going to do that for everybody? I mean, is that the plan that you're going to take on everybody's loans? And as far as I can tell, how can you not have 100% deposit insurance now? This whole $250,000 thing, you just bailed out particularly SVB. All those depositors were saved. So to me, that you just wrote a contract. So it's just more rescue. And I think there'll be new ways coming that they're going to rescue us, going into next year.
I have sort of a conspiracy theory on that.
Well, that's right up my
bank
alley.
merger. Here's my thought. My thought is if the Fed does want to usher in a CBDC, and I know Powell doesn't, but Powell's not going to be there forever. It's much easier to do with a smaller amount of banks. Say if you have 5, big banks, something like Canada, that would be a lot easier to do than trying to get 4,000 banks on board.
We have a different economy.
That
We're a different country. We have a different economy. I'll tell you, listen, I've covered community banks my entire career, and most people, don't have that purview. What I do, my profession is very, very small. And what I get to see, the totality of what I get to see, which is individual banks all around the country. I get to see their portfolios. I get to see their loan portfolios. Not even they get to do that. Individual banks can't just go walk around in the country and say, hey, let me check out your portfolio. So I get to do that. And all my career, I've stayed in these communities. And let me just tell you, you can't not have community banking. There's just no way. You don't understand the kind of loans that get done. I got a bank in Pennsylvania, and the CEO one day explained to me, he goes, I really, really like lending to the Amish community. Well, geez, that's weird. Why? Well, because it's a community. And if one guy were to fail on a loan within that community, it would taint the entire community. So when one guy struggles, the rest of the community will come to his rescue and get the loan paid off. Wells Fargo's not going to give a shit about that story. They don't know that story. JP Morgan sure as hell not going to care about the Amish community. So this whole idea, and I see it on Twitter too, we just need 4 or 5 banks. It's never going to happen. And no, we do not. Community banking is so important in this country, and primarily is the one who funds most of the employment in this country. I think that's what gets lost in media and on Twitter, on any social media, just even in conversations, around, people not in the industry. Jamie Dimon's not a banker. He's a superstar. He is an NFL quarterback. He gets paid for his popularity. I mean, that's not banking. And by the way, I covered him, when I was at Bloomberg. He's a great guy. He's one of the best senior executives that I ever encountered in my whole career at Bloomberg. But don't look at that as banking. Don't look, even these super regionals, what you need to be looking at are these small community banks. They're the ones we need to survive. They're the ones that have been around since the mid 1800s in many cases and survived everything since. That's what we need to be focused on. So maybe we don't need whatever the number is now, 4 something thousand, but I guarantee you we do not. 4 or 5 will not work.
Well, that makes me feel better. To be honest.
Well, look, I'll give you one last example. I had a bank in, I forget what, it was up in the Northeast somewhere. They opened a branch up in a neighboring city that they had never been in before. It was not going to be profitable anytime soon. But the reason they opened it up, and this is back in the financial crisis, is because all the big banks left. They just closed shop. A small little, place there for everybody to have some banking. And then all of a sudden, this little town had nothing. And so out of duty to the community, this bank put a branch in there. And that again leads to, community banking. And I'm sure by now that it's very profitable being in that town, because in that town will treat that bank as well as they can, because they're grateful for what they did. Last anecdotal story there.
Love it. I want to move over to residential real estate right now. Do you see any signs of trouble brewing in that market? I know you posted something on multifamily building distress, but yet we have, another survey that said 80% of builders plan to start more homes in 24 versus this year. So do you see any I guess overall, do you see any signs of trouble brewing in just the residential?
Yeah, I mean, look, I'm not a huge analyst in at all, really, in resi. But all I can tell you is from experience, it feels like '06. That's what it feels like to me when I look at these, young builders that are around. Now I'm in Nashville, which is a super hot city. It has been for about 10 years or so or more. But the behavior is the same as I saw in '06, where these guys are in their 30s. And I'll ask them, I say, well, hey, what do you do? Oh, well, I was an accountant, but I got into home building about 5-6 years ago. And that's all I do now. I've got about 37 homes going right now. I'm just like, the whole time I'm thinking, holy shit, dude, you're going to go so bankrupt. And that's what I'm starting to see now is more and more of these homes are for sale. And I'm constantly seeing price cut, price cut, price cut. And to me, it's in the process of blowing up. It's just exactly how I felt in '06.
Something to look forward to. But, and you're not the only one. I had Danielle on, and she also sees signs of trouble, and I had Melody Wright on as well, who also sees signs of trouble. So, interesting that a lot of people are starting to
You
see
can get
kind of this.
I forgot his last name. Go the Twitter guy Logan something. Love him to death, but that's his industry. So he's like the most positive housing guy on the planet, and it'll never ever crash, and it'll always be awesome. And maybe you should get him on and let him make a case.
Definitely DM me his
I
info.
will. I'll find him.
Love to have him on. Perfect. And then the last question for this round. What are your thoughts on the maturity wall coming for banks' unrealized underwater bond portfolios? Should we expect any trouble? And, you know, if so, what kind of programs do you see coming in to save them? Because obviously they'll probably
Well,
be
they're being
fixed, right?
saved right now, right? I mean, we've, losses, unrealized losses have already come down quite a bit because, 10-year went from 5 to 390 as one metric example. So yeah, rate cuts are going to solve that problem, but you got to understand right now. And Chris Wallen is really good to watch on this too, because I think he's strictly banks and his commentary is really, really good. And he's like, banks need time. All these bonds that we're talking about, they go to par. This whole idea that they bought bad bonds is just absolute nonsense. Most of the banks, I'm talking most, it's all agency backed stuff or US government treasuries. So they weren't bad bonds. That's just duration, man. That's what happens. You raise rates that fast. It's just math, but they'll all go to par. So every dollar that comes back, it comes back at par. So if it's 80 cents 2 years ago, it's 90 cents a year ago, and it matures today, it's now 100 cents. So, this whole idea that it's this horrible thing, and that really got worked up with, Silicon Valley, is that got pointed. I don't know who decided that was going to be the reason that they failed is because they took a loss on their AFS portfolio. Well, think about that. So that was what, March? They take a loss in their AFS portfolio. And I know they were trying to do a capital raise at the same time, whatever. But the main reason was they took a loss in their AS portfolio. Oh my God. It opened everybody's eyes up to, oh my God. Well, we've got at least 200 banks who've done that in the third quarter. And now it's being celebrated. Now it's a positive. When a bank does that now, their stock price goes up. So you got to figure the Silicon Valley Bank executives are like, oh my, what? That's exactly what we were doing. We were doing the right thing, And so I think my point is, it's like, look, unless you're forced to sell, strategic sales are being handled just fine. Unless you're forced to sell, which is basically a run on a bank, it's not a problem. But the fact is, a run on a bank is inexplicable. I do it as simple as this, particularly in today's world. I'll explain to you, you go driving down, any of you would admit this. If you're driving down and you go past a bank branch that you got all your money in, and I don't care how much it is, I don't care if it's insured or not, and you see 100 people lined out that door, what are you going to do? You're going to pull over, you're going to hit your phone and move your money out of that damn bank. You don't give a crap what the reason is. You just know something weird is going on and I'm getting out of something weird. Turns out they were giving out free donuts, but you found that out later and you didn't care. I just wanted to make sure. So that's how inexplicable a bank run. Okay. And I'll give you one more example. And then just because these are things I don't ever see anybody talk about. So during the financial crisis, all hell's breaking loose, right? Banks are under distress, blah, blah, blah. I've got a meeting in the small community bank somewhere in Arkansas. And, and I'm talking probably 400 or 500 million total assets. So very small. And I had to get there. I got there right, before they were going to open. So I go up to the door and it wouldn't open. So I knocked on it, and this lady just comes, this old lady, comes whipping around, and she's waving her hands and she's just all fluttered. And I'm like, oh my God, there's a bank robbery. What the hell is going on? And she's like, get in here, get in here, get in here. I'm like, what? Now, mind you, I'm wearing a suit. And so back then we still wear suits. And she goes, look at you. You look like a Fed regulator. You're going to cause a run on our bank if somebody sees you standing out there knocking on the door at this time in the morning. And so that's the mentality of how crazy a bank run can get started. In my opinion, that's what happened to Silicon Valley. So that a lot of what you heard about them, to me, was all bullshit. So right now, you see banks handling the losses. They're either going to wait, let them roll off naturally. They're going to take them now and handle it. It's just, to me, it's not a story unless there was some sort of a bank run.
Awesome. Thank you. All right. And we'll go back to Remy. What, if we do go into a recession, how hard do you think equities get hit? I mean, what do you foresee, or what are you seeing in the charts?
I think in this, if we get a recession, which I think we do, and I rested my case many times this year, 100%, 100% of the time with a recession, you have the market that corrects. Okay, that's a fact. Now, depending on many things, it corrects more or less. I think we're looking more at something like 2000-ish, maybe. So up to 30%, something like that. That's what I see, based on the business cycle, based on where the level of current levels of everything. Basically, we still have a lot of excess post-COVID in prices everywhere that we kind of need to clear. When you look at trend lines and stuff, we're well above like anything everywhere. So I think, 30%, something like that makes sense to me.
And do you have a time frame you're looking at? Second quarter, third quarter. I mean, because I guess it depends on when they start cutting rates. But in your work, do you see a specific quarter, at least, that we should be looking at?
So it depends, like you said, depends when they cut rate and the reason exactly why they cut rates when they do it. If they do it because they know, or they know the data is coming bad, which is going to be the next one coming, is unemployment should be rising. Then they're going to try to contain, the damage of the collateral damages of that. So I think it's first, for the market to bottom, I would like to see, or to correct, I would like to see the ISM get weaker. I think ISM hasn't bottomed yet. I see weakness coming in the first quarter. It will be quick. Bottom in ISM are very quick, very sharp. So I think I would like to see that first to confirm as a signal. And then obviously, how fast and when the cut rate is going to be important as well. Are we in a situation where the market keep going up until we get a first cut, or it just goes sideways from here, like a couple of percent, like a few percent up and down, nothing serious. We're gonna know that, I think, from January, where our people get positioned when the year starts. We're gonna have a bit of an idea, I think. Yeah.
Hey, Tracy, can I ask Remy a question?
Yeah.
So Remy, so here's my thought on this. And if you go back in history, it seems to always work out this way. I think whatever percent stock market going down, if it were to do that, I think as long as it was controlled, the Fed will allow it. However, what I said many times on Twitter is, particularly when we were doing this higher for longer bravado, I said, I want to see your resolve if you start to get several limit down days. If you start to get limit down days where it looks uncontrollable, I think the Fed comes in with everything they got, like they've done in the past. Do you have any opinion on that, Remy?
No, I think you're right. I think you're right. and you just made me think of something, the market really turned around on 26th of October. And basically that was when Yellen announced that they were going to use short-term bills instead of long-term debt and stuff. And if you look at all the data, all the charts around that date, like you look at currency, commodities, prices, stock, any stock, they were all about to break on that date, all of them. And they managed to turn things around just using that trick of short-term debt. And I think that's going to work until it doesn't. And especially, they as the repo market's getting empty. I think when it gets empty, that's when they're gonna have to cut. They might have to cut, like rushing very quickly, because obviously of the debt levels and they can't keep adding like debt at 5%. So that the compounding of rate of interest on top of the 34 trillion now, it's gonna basically quickly add up into trillions, not billions anymore. So I think it's we're gonna have a bit of that as well. Now, depending of the velocity, again, as things start moving, trying to contain it, it's just like that's when we're going to start seeing volatility, which is another signal we want to see, during a recession or when it happens, to confirm it.
And then what other data are you specifically focused on right now? Or, what charts should we really be looking at and that you have in your focus right now?
So I've been really, really focusing on US consumption, because I think, we've been told the US consumption is strong. The US consumer is strong. The debt service is much lower than it was in 2006. They keep spending. But the reality is, if there is a recession, or if there is not even a recession, complicated times ahead, like what they learned in 2000, what consumer learned in 2008 is that they needed to deleverage debt very quickly and manage it. And I think this time around, they're going to be we can see the data. People are being careful. Even if you look at in nominal term, debt is all-time high everywhere, right? Auto, cars, students, consumer credit, mortgages. But when you look at the structure of the debt, what happened is since 2008, they actually been adding a lot of consumer debt credit. In terms of percentage, compared to what it was, I think now it's like 65-35. But that debt is actually short-term, more short-term maturities. So it's something that could also backfire quickly if there was and obviously if the unemployment rate and stuff start to move up, then we already see like the default are moving up. We've seen the headlines about the students loan not being paid. And I think this is the Fed is going to have to face all of that next year. Is basically default are going up. It's happening. Employment is always the last domino to fall. It's expected to happen. We see it weakening in data. And for employment, for example, I like to use subset of data to have good indicators. And if you look at the unemployment rate, it's fine, it's low. But if you look at the rates of unemployed people as a total number, it's actually rising. It's at 7% now, and at 25%, it's 100% recession. Then you look at temp services hiring, they're contracting like at recession level. Then you look at permanent job loss, which is also growing at recession levels. So there is a lot of weakening signals already showing up in a employment market. So I think all that is basically going to sum up next year, and construction, is going to be the big thing for me. That's really what I'm looking at and focusing on.
Are you watching like delinquency rates? And I know that they're not terrible right now, but the rate of change is pretty quick. Is that something you're focused on?
So Yes, I looked at them. Now it's not, if you look at it as a percentage number of the total debt, it's not going to be crazy. I don't think it's going to be a systemic risk, but it gives you an indicator of consuming behaviors. And that's what I'm interested in. Now, also, all those consumers, they're basically net loss. All those consumers defaulting, they're becoming net loss for consumptions until they recover and all that stuff. So for me, I think it interests me more to get like an idea of the market than like purely like the numbers and what's going to happen with them and stuff. Because now, you have what, 40, I don't know how much debt, total debt, I think maybe 70, 80 trillion total in the US. Consumer credit, 5, total households, 20. So if for those default to mean something now, they need to really, really, really go up. If you compare to the total debt. So I don't think the default in itself is such a problem. Like I said, it's more about a dynamic.
That makes sense. And then I don't know if you had any thoughts as well on the real estate market, if that's something you follow or not.
Yeah, well, I follow the housing market a lot, and you see it in the data. The consumption, the weakening consumption is obvious. There's obviously a lot less house sales in the US. The price went up too much during COVID. The financing costs are like way too high compared to the trend in the last 40 years. People are not buying homes. Now, what happens if people are not buying homes? They're not buying appliances. They're not buying electronics. They're not buying garden stuff. They're not buying materials. And all of that, you see it in the retails, in the growth in retails, in all those sectors. They're all like falling. And to me, the chart shows that they all have a lot to fall. Yeah, still. So I think, for me, the housing market is giving me a good layer of information for consumption. And obviously it's the most expensive item, in the economy. Now, if you look at all the sentiments and stuff, the Michigan consumer sentiment about high prices, real estate is still way too expensive for everyone. So yeah, I think for me, it makes sense to look at it this way. Like I said, so it's just like a layer of information that I use on top of the business cycle and many of the stuff, liquidity, etc., etc.
Hey, Tracy, I'm going to jump in again real quick if you don't mind.
Yeah, go ahead.
So take a quick step back. Remy nailed it on delinquencies. It's an indicator. Don't look at so much the totality of how much money it is. And, I hear these, comments, well, it's only $1 trillion. And I'm just like, Jesus, that's where we've come, But the one I want you to watch, I think is really, really important right now, is going to be student loan delinquencies, because they've started the payments back up. And I think it was announced yesterday, the day before, somebody said that the default rate right now, let me do that differently. 40% have not started paying. Now it's early. They'd only started in October, but here's what a lot of people don't know, is that when they do those default rates, it's a little bit rigged. And the Fed admitted it one time back in 2012. It said, oh, by the way, on these default rates, we have all the loans that of kids still in school, kids or people in forbearance or deferment. Basically, a large swath of borrowers are not required to pay. Yet that's in the denominator when they calculate the delinquencies. And that's it was back then about 44% of all borrowers were not required to pay. So when they talk about delinquencies being 12%, 13%, it's actually 24%, 26%. That's the actual default delinquencies on student loans. So when they said that 40% haven't started, probably doing the same thing. Probably half the borrowers are not required to pay anyway. So really, it's a much, much, much larger percentage. Now, what's important is Yeah. Okay. And this is another huge topic, on the same thing. I think Biden said it's not going to hit your credit if you don't pay until next October. They won't start, notifying the credit agencies that you're delinquent. But interest is being charged. So when you see these people, these big percentages not paying, probably means they can't pay, can't afford to pay. Probably means they just assumed that it was all Elizabeth Warren was just going to forgive it all anyway. These are not good signs for the consumer. And let me just lay this one on everybody who hasn't heard this already. There's a monster ramification here that I don't think most, and I'm saying most lenders took into consideration since COVID. And that is the FICO score has been basically falsified for the last 3 years because you didn't have to pay your mortgages for a while. You didn't have to pay your student loans. You didn't have to pay this and that and that. You were getting a ton of money in stimulus. You were getting, ERC and, PPP and all these different things where the money's just flooding the world. It artificially inflated everybody's FICO, and lending was getting done and trust me, I've asked, what's your number one metric when you go to a lender who consumer loan? Well, FICO, that's our number one thing. Auto loan, same thing, right? Well, that's getting ready to get unwound. And it's one example. I have one client who admitted that it's called a credit migration study. It was astounding. Basically what this is, it's just very simple. Took his auto loan, said, okay, what were the FICO scores when we issued the loan, when we originated the loan? And of those still existing loans, what are the FICO scores now? Okay. He had issued in auto, 1% of his auto loans were subprime, below 660. It now sits at 24%. That's a move. That's how much it's moved, that dramatically, meaning that all those credits that he gave to the A, the B, the C, the D, they're now 23% of those has moved into the failing subprime category. And so that's what's going on right now. And when you do the student loans and you don't report what's going on, it's going to keep their FICO scores from falling. But as soon as they start reporting those FICO scores are going to come down dramatically. And now you got even less reason for them to be able to have consumer borrowing purchasing power. And
that makes a lot of sense. I'm glad you brought up auto loans because that also seems like another dumpster fire to me.
And I will add one thing to that is, so when I speak about dynamics, if people are not paying their student loans, it's because they have to pay other things that are more important. Therefore, they're not going to spend in durable goods. They're most likely spending on food, rent, and all that stuff, which is, the point I was making about consumption and dynamic and debt levels and stuff. Most of the time, those people are not big because they can't, not because they don't want. Some maybe are trying to play the system, but most of them are not.
Hey, many can't, Remy. I've known a few, and they adjusted their lifestyles. It's just human nature. When I haven't paid this goddamn thing in 3 years, they're never going to make me pay it. And so I'm going to adjust my lifestyle. I've got an extra $300 to live on now. So I'm going to get a bit of a nicer car. I might get a nicer apartment, whatever. And now, I mean, literally I've had several, people say, now I'm screwed if they make me pay that student loan again. And
that's part of that's part of all the exuberance in prices everywhere, post-COVID, basically 2021.
That's right.
That's exactly that.
Excellent. Well, we are coming up. We are at the hour. I don't want to take too much of your time. So the last round is the same question for both of you. It's either talk about something that you wanted to talk about that we didn't get a chance to cover, or what should we as investors really be focusing on, say, over the next 12 to 24 months? And we'll start with Randy.
Okay, I asked Remy for permission to do this, so everybody can know that. I really think everybody should go read Remy's got a thing, a monologue out there called The Fall of a Giant, which basically is his experience with crypto and Real Vision and exiting Real Vision. It's super raw. It's super personal. And it's really super brave that he shared his experience. I think most would not have shared, but I think it's important because it's such an incredible learning experience of basically when you just fall in love with an investment and you literally hate all other investments or you ignore all other investments. And it's just, to me, he provides a really, really important lesson in there about being robust, not just in investing, but really being robust in life. Kind of a Nassim Taleb theory that, that's what you're looking to do is you be robust. Don't be myopic. And, I really would highly suggest everybody go read that. And Remy, I don't know if you have any comments on it. I mean, I just thank you for doing that. I was so impressed when I read that because I was like, man, what an outstanding individual to share something that most would.
Thanks, Randy. Well, to be honest, when I did it, that was like 2 days after the Luna collapse.
Were you like Jerry Maguire in the middle of the night?
No, basically I just hit a wall, the worst wall in my life at that moment. And, I was very vocal about my investment. I was like starting to be a bit known in the crypto world because of it. And it suddenly everything collapsed. And what I realized is, okay, now I'm messed up. I messed up. My reputation is down the drain. The only way I can have a chance to recover is to own it as quick as I can. And that's why I've done it.
And that's how I took it. It was amazing.
It was excellent. I agree.
Thank you.
And then, so that's your final, is that your final statement, Randy? Did you have anything to add to that?
No, I don't think, I think that, look, my Twitter account and my philosophy is always going to be watch out. It's just the way I've always been in my life. And, I love people come, and I have such a respectful, beautiful followers and in a community. It's just such a great tool if you know how to manage it. But, just that's, be careful. There's always hidden things out there. And, don't get too euphoric, try to temper your enthusiasm. And that's all I'm really trying to do. Is just try to bring some reality and things that I see that no one else gets to see. And hopefully people find it useful.
We do. I think your feed is excellent. I appreciate all that you do. Remy, your final thoughts? You can talk about something that you wanted to talk about that we didn't get a chance to cover. Or what should we as investors be really looking at over the next 12 to 24 months?
Right. So first, like Randy, right now I'm very cautious. When you see too much euphoria everywhere, especially on social media, I'm becoming very skeptical. And the one thing to think about is we haven't been, except for COVID, COVID happened. We haven't been through a recession or through a tough time economically with all the tools we have to communicate now. So in 2008, you didn't have Twitter or all the social media network like you do have now. You didn't have as many people using it globally. So now we have basically a whole new flow of information it reached very quickly. And I think, that's maybe in 2008, we would have spotted earlier. Maybe in 2008, people would have shared it. Maybe in 2008, the market would have not collapsed like it did if we had it. So I think it's an important layer to keep in your head. Basically, is we are living in a different time, and then you also have Twitter, the algos, and the way the content is being pushed out and stuff. Now, in terms of what I'm looking at, I'm positioned in uranium and nuclear. I think nuclear next year is going to have a chance to like really come back. We've seen it. We've seen the switch this year already. Price move up a lot, but I think all the if they want a chance to reach the mandate on climate change, although they throw them out of the window lately, I think they don't have a choice. So it's a sector I'm looking at. Another sector I'm looking at is cybersecurity. I think, we live in a world where everything's becoming more and more digital. We're generating more and more data. So I think as a long-term investment thesis, I think cybersecurity makes sense. You have few ETFs to make it easy. But yeah, I think those are the things that I'm looking at for the moment. Then what I'm really like looking for those signals. If the market correct, I'm not going to short it. I'm not, shorting, take too much skips, but I will wait for the right moment to step back in. And I think it will be quick, yeah.
Excellent. Thank you both very much for your time today. Please follow these guys on Twitter. They both put out excellent information and are all around really good guys. There will not be any spaces next week for the Christmas holiday, but we will be returning on after the new year. So enjoy your holidays, everybody. And we will see you in January.